Anand Agarwal, CFO of V-Mart Retail, joins in after what was a decent performance in a quarter which was, seasonally affected by the festive season shift in the calendar. So you don't look at the third quarter in isolation, look at Q2 and Q3, and there's a 15% growth that the company's reported across both these quarters. For the third quarter, it's a 10% revenue growth, near 22% EBITDA growth as well. Thanks a lot, Anand, for joining in. Congratulations. Decent performance coming in. The street likes it as well. The question is, what's your full year target now and an FY27 goal? Why do I ask it? Because you said that you expected 20% growth in the festive season. You put Q2 and Q3 together, it's 15%, right? So basis this, now what does your full year target stand revised to? And also, for the next year, if you could give us an early insight.
Well, thank you, Mangalam. Always nice to speak to you. So, yes, in perspective, we had spoken around 20% growth that we were targeting for quarter three, for whatever right, wrong reasons, external, internal. I think the growth did not come through as planned, but still, I think the growth aspirations remain still very strong. We're still looking at closing the year at a fairly robust number, growing between 15 to 18% over last year. A tad bit lower than what we had earlier estimated, but still very, very strong on the overall guidance for the long term. We are still seeing a lot of good customer sentiment as well as market, traction coming in. All the new stores that we are opening, we are getting very, very good traction on that. So we are very, very gung-ho on the overall trajectory. Percentage here or there may not really matter so much, but more important is that we are seeing good profitable growth, and we're not per se buying growth, to get a headroom sales number in.
No, we get that point entirely, and that's the more mature thing to do as well, especially coming from someone like you who's been around for so long and understood this cycle too. Just wanted to confirm once again, you said you will end this year between 15 to 18% of revenue growth, right? First 9 months, you've done just about 14%. So that puts a lot of onus on the fourth quarter to do that. And by being profitable, what does your exit margin stand at? Because the first 9 months, you're at 14.5%, which is a near 200 basis points improvement.
So as of now, very difficult to predict the exact margin percentage. But having said that, we have set in motion improvement that is very visible for the first 3 quarters. So we are hoping that we should be able to continue this momentum even in quarter 4. Technically, quarter 4 is not the best quarter of the year as far as profitability goes. Quarter 4 as well as quarter 2 are always the lean periods where a major part of the quarter actually does not give in a lot of profitability. January and February are not very, very big months. March is relatively a big month. But yes, irrespective of that, I think we should continue to see some amount of margin improvement. May not be as high as what we have already delivered in this quarter, but definitely some improvement over last year.
And you're confident of 15 to 18% despite the fourth quarter being lean and you having done about 14% in the first 9 months, right?
Yeah, I think 16% is the number that we have tracked for the first 9 months. But yes, we should be looking at, around 15 to 17% for the full year.
And what about the, margin mix between V-Mart and Unlimited? It's a beautiful performance that Unlimited has reported this time around, where the EBITDA for that business has grown over 40% and the margins are at par with your V-Mart business, if not better. Has it been maxed out, or is it likely to show some more outperformance as compared to V-Mart?
No, I'm still very, very optimistic on Unlimited. So while on our post-Ind AS reported number basis, the Unlimited margins optically look good or as good as V-Mart, but the real number is pre-Ind AS numbers, where the higher rental cost in Unlimited still does not deliver a much higher profitability even till date. But having said that, I think I've been repeating this for a long time that we are very, very optimistic on Unlimited. That is a very virgin territory for us. We have a lot of headroom to grow there. The profitability for all the new stores that we are opening there is fairly good. In fact, much better than even V-Mart stores. So as we increase our network there, the law of averages will catch up. The newer stores will overshadow the older stores. So we will have much higher profitability as we move forward. So we have put in a lot of faith and aspiration in behind Unlimited, and we will continue to grow and make this even bigger.
Well, Anand, since we are on the subject of store addition, you tell us what are your plans for FY27? How many stores are you planning to add? More importantly, how many will you end FY26 with, part one? How many do you plan on adding in FY27? And if you could share the mix as well between V-Mart and Unlimited.
So, Thomas, I think at an overall level, for a long-term trajectory, we should look at around 13 to 15% area growth every year. Now, a base of 500 odd stores last year, so that translates to roughly around 75 stores for FY26. And on that base, roughly around 85 stores for the next fiscal, which is FY27, as you asked. The ratio between Unlimited and V-Mart will somewhere between be 80-20. So 80% will come in V-Mart territories and 20% will come in Unlimited territory. Irrespective, I think as management, we still are very, very more optimistic on expanding more in South India under Unlimited. So we will try to expand more in Unlimited. But as of now, as a guidance, what I can say is 80% in V-Mart and 20% in Unlimited.
All right. So 15% addition is a lot more palatable than, the number of stores, because if you take the average store at around 8,000 and then, you make those projections, then you understand that annually the number of stores by themselves will obviously increase versus the previous year. And that explains why this year you've done 65 already, as against the previous few years where the numbers were around 55, 60, thereabouts. Just a final question before I let you go. I wanted to understand, on a larger macro theme, where what is the play here? Is with V-Mart obviously having so many stores targeting tier 2, tier 3, tier 4 and beyond as well, there are a slew of many other retail players as well, not just the listed but even the unlisted plays. You have many who are raising serious amounts of money from PE and other investors too. And then the larger players are also looking to access this very same market. Is there a risk of saturation out here? Because, I mean, the runway has been made by you. You've showed the proof of concept. Now people would want a little more, and not necessarily from the same store, right? So just wanted to understand whether it's an access thing, it's a repeat thing, or it's a store addition thing. How should one look at this space?
There are two parts to this, answer. So one is obviously when you have more number of people coming into the same space, which you have sort of created and built, it validates the entire hypothesis that, this is something real which is happening on the ground, and this is definitely sustainable. Because while you are right, there are some of them who are unlisted, but there are also a lot of them who are listed. And thereby the performance is already visible and, available for everybody to see. The second part is the runway to growth. As we speak, even today, not more than 30% of the apparel retail business in India is still in the organized segment. So, if you include V-Mart and everybody who's listed and everybody who's unlisted, all put together, we do not contribute more than 30% to the overall size of the market. And 10 years back, this used to be less than 10%. So in the last 10 years, that 10% has grown to only 30%. So there is still 70% headroom where the shift from the unorganized to organized still needs to happen. And over and above that, the market also has to grow or is growing. As the GDP is growing, the economy is growing, the consumption levels are growing. So there is a significant headroom for all of us to grow. Now, who will deliver better will also depend on who understands the customer, the regional relevance, is more disciplined, is a long-term player, and all of that. So that is, anybody's guess. But from a market perspective, I think it's a very attractive market. There is a lot of validation by, other players who are coming into this market, who are proving this concept right. And there is still a lot of headroom for all of us to grow.
As Charles Darwin very famously said, the fittest will survive. We'll see how time tells as competition rises in this space. But Anand,
retail, I think, the ones who do the boring stuff regularly over and over and over again and keep doing it with absolute discipline are the ones who survive.
Boring is always good, isn't it? Sometimes, or more often than not, at least. Anand, pleasure having you today. Thank you so much for sparing time and joining us. I wish you good luck for the rest of the year as well. Take a short break, and market technicals on the other side. Jay Thakkar from ICICI Securities joins in.